Okay, hi, welcome back to this course on infrastructure finance. This is lecture number 17. We have been looking at various aspects of project financing for the last couple of lectures, and we will try and do so in this lecture as well. Specifically, we will focus on some of the attributes and motivations of using project financing. And what I am going to really look at first is how project finance helps to avoid or overcome some of the traditional management problems with respect to investment making. The first thing that I would like to point out is its ability to overcome what is called as your underinvestment problem. Before we really come to what is the underinvestment problem, broadly we know that from our earlier discussions that when a firm finds an investment opportunity that has a positive net present value, it undertakes the investment. That is, the benefits are more than the investment or the cost, and by undertaking that projects for which the benefits are higher, the firm actually benefits. So the net present value is positive. So what is actually a firm? If you want to illustrate, so the value of the firm is nothing but the series of projects, and if you assume that each and every project has a net present value, project 1 has a net present value 1, project 2 has net present value 2, and so on. So seen from this perspective, the value of the firm is nothing but the sum of all the net present values of the individual projects. Now if a firm takes up a project that has a negative net present value, that reduces the overall value of the firm. Only if the firm keeps consistently taking up positive net present value projects will the firm value increase. Now by the same token, it is also understood that for a firm that is intent on maximizing its value should accept all the positive net present value projects. If the firm for some reason does not accept all the positive net present value projects, then it forgoes some amount of value, it forgoes some amount of profit making opportunities, and that is not considered to be a good management or investment practice. So therefore a firm should be in a position to undertake all positive net present value projects if it is intent on maximizing the firm value. Now what is this underinvestment problem? An underinvestment problem can occur when there are situations where the firm does not undertake certain positive net present value projects. Now under what circumstances can that occur? Let us discuss that using a simple example. Let us say there is a firm now for the coming year the economic conditions can be either of the two. The economy can be in a recession or the economy can be in a boom. So the firm actually has a value that differs in either of these two conditions. Okay. So now let us consider a simple example where the firm in a boom and in a recession. So the value of the firm in the boom period is, let us say, is 5,000, and the value of the firm in a recession is 2,400. Because during the recession the economic conditions are bad, the business prospects are bad, so therefore the value of the firm is much lesser as compared to what we see in the boom conditions. So now let us also assume that the firm has certain level of debt, and by the end of the year the firm will have to repay the debt that actually it owes to the lenders. Now if we assume that the level of debt that the firm will have to pay back to the lenders is 4,000. Okay. So for debt debt holders would need to be paid 4,000. During the boom, if the economy is in a boom, the firm is actually having a value of 5,000 and therefore the firm will be able to pay the debt of 4,000. The remaining value of 1,000 will go to the equity holders. The remaining value of 1,000 will go to the equity holders. Now let us look at what happens in a recession. In a recession, the firm actually has a value of only 2,400. So therefore the debt holders will not get paid the entire 4,000 that the firm owes to them, and the maximum that the debt holders will get paid only is 2,400, because that is the maximum value of the firm. The firm will not be able to pay the entire debt level of 4,000 because it would be unable to, given the recessionary conditions in the economy. And the equity holders during a recession, they get nothing, simply because all the value is expropriated by the debt holders. So if you assume that the boom and the recession occur with equal probability, that is the economic boom has a 0.5% probability and the recession has a 0.5% probability, we can all calculate the economic value of the firm, the economic value or the expected value of debt that will get repaid, and the expected value of the equity. So the expected value of the firm will therefore be, I am going to put it in between, the expected value. The expected value of the firm is nothing but half of 5,000 plus half of 2,400. So that would be 2,500 plus 1,200, this will be 3,700. So this is the expected value of the firm, and the expected value of debt that likely to be paid would be half of 4,000 plus half of 2,400. So this would be 3,200. And the expected value of equity would be nothing but the expected value of the firm minus the expected value of debt, and this will be therefore 500. So this is the current situation or the forecast for the firm. Now let us assume that the firm has an opportunity to undertake an investment project, and for undertaking the investment project the firm would actually need to make an investment of 1,000. If the firm makes an investment of 1,000, then it results in a benefit of 1,400 irrespective of the economic conditions. Okay, so this is a very simple example, but let us assume that it is a very good investment opportunity. The economic conditions do not affect the outcome, so therefore the outcome of the project or the outcome of the investment does not vary despite the change in the economic conditions. So you make an investment of 1,000 and the firm value increases by 1,700 in either the boom or in the recession conditions. Okay. So now let us look at what is going to happen with the project. So the firm with the project. So this is with project and this is without project. Now the value of the firm during the boom period would be 5,000 plus the benefit of 1,700 because of undertaking the new project. So the total would be 6,700. Right. So this is the value of the firm because the firm undertakes a project. During the recession, again the value of the firm will increase by 1,700, and so therefore the value of the firm during the recession would be 4100, right. In both the economic scenarios, the value of the firm increases by 1700, it does not change. So what happens to the case of debt, right? What happens to the case of debt? So during the boom period, the debt holders will get paid the entire 4000, right? The debt holders will get paid the entire 4000. The firm is valued 6700, obviously it is higher than the value of debt, the debt holders will get paid. And during the recession also, the value of the firm is 4100 and the value of debt is only 4000, so the debt holders will get paid in entirety. Now let us look at what happens in the case of equity. So what happens in the case of equity is, during the boom period, the equity holders will get the residual value of 2700, and during the recession the residual value is only 100, which is what the equity holders will get. So now let us calculate the expected values for all these three cases. So for the firm, the expected value would be half of 6700 plus half of 4100. Okay. So this will be 5400. This will be 5400. So essentially if you look at it, this expected value increases by 1700, so it becomes 5400. Now let us look at what happens in the case of debt. The debt holders get paid 4000 in both the scenarios, so therefore the expected value of debt will be 4000. And in the case of equity, the difference between the expected value of the firm and the expected value of debt, so that will be the expected value of equity, so that will be 1400. Now the question is, will the investment likely to happen, will the investment in a new project likely to happen? If you actually see, the firm undertakes investment which costs 1000 and then the benefits of this investment is 1700. So therefore the benefits are more than the cost, so this is a positive net present value opportunity, right. It is a positive net present value opportunity because the benefits are more than the investment cost. The investment cost is 1000, the benefits are 1700. So technically speaking, the firm should actually undertake this investment project, but for the example that we are talking about, will this kind of investment likely to happen? Now the answer would be no. Why? The answer would be no for the simple reason that, so in this case the entire investment of 1000 is being made by the equity holders. The debt holders are unlikely to make the investment simply because the firm is already on the verge of bankruptcy, so therefore the entire amount of 1000 is going to be invested by the equity holders. So what happens is the equity holders invest 1000, but the expected increase in the equity holders value is only 900. Okay. So earlier without the project the expected value of equity was 500, after undertaking the project the expected value of equity is 1400, so the difference is 900, whereas the equity holders are making an investment of 1000. So in essence the equity holders do not get the entire benefit of the project gains. So who is then getting the benefit of the project gains? The project gains are actually going to the debt holders. Earlier the expected value of debt was 3200, now that has now increased to 4000 without any participation from the side of the debt holders. So what is likely to happen is the equity holders are losing out and the debt holders are gaining, and at the cost of equity holders. So therefore equity holders are unlikely to approve of this kind of an investment, which makes them worse off as compared to what they were before. So this is a classical underinvestment problem. In this case it is an underinvestment because a firm is likely to forego a positive net present value opportunity, and the firm is foregoing despite the fact that it might actually affect the firm value because of the because of the way capital has been structured, the amount of debt and the amount of equity. Now consider a situation, if this project has been implemented separately outside of the existing firm structure, then the investment would have happened simply because of the fact that this is a separate project and this is a project which has a positive net present value, and all the investors are likely to benefit from the project benefits, and therefore the firm would have implemented the project. So this is where a project financing technique can actually come in. What is project finance? A project finance is a way of implementing a project in a ring fenced entity. So it is actually implemented outside of the existing corporate structure, and therefore by implementing it outside of the existing corporate structure, we are trying to avoid this underinvestment problem. By overcoming the underinvestment problem, it also helps to increase the value of the parent firm. Okay. So thus an important takeaway or benefit of using project finance is it helps to overcome the classical underinvestment problem that we see in corporations that have certain level of risky debt. When we say risky debt, that is a certain amount of debt which is unlikely to be paid because of changes in or uncertainties in the business environment. So the example that we talked about is a case of firm with risky debt, where some level of debt is unlikely to be paid if there are any adverse changes in the business environment. In a project finance entity, in a project finance structure, we actually have a situation where the economic interests of debt holders and the shareholders are much better aligned, and therefore the issue of the underinvestment is less pronounced as compared to what we probably see in the traditional corporate structure. A second important an advantage of project finance structure is the way in which we allocate free cash flows. Normally what happens when the company implements projects, the company gets some revenues, after deducting all the expenses the company makes some profits. So we have what is called as your free cash flow that is available to the firm from the profits that the company makes. So the company has two options. Option number one is to actually declare these profits as dividends and distribute the earnings to the shareholders of the firm. Second, the company can retain these kinds of this surplus cash and use it to reinvest in other profitable investment projects. Now in a project finance company, there is no need for any reinvestment, simply because by definition a project finance company is not expected to make investments in other projects. A project finance is a ring financed entity, and the boundaries of the project are a lot clearly defined. So the free cash flow that is needed in the traditional corporate for subsequent investment opportunities is not needed in the case of a project finance structure. So what is the kind of impact that we see here? The impact is managers do not need as much free cash flow in a project finance entity, and therefore they are forced to give it back to the shareholders, or they are forced to use it for repaying debt. So the discretionary powers that exist in the hands of the managers in the conventional corporate structure is lot lower in a project finance structure, simply because there is no need for retaining this surplus cash flows, for allocating it to other investment opportunities. The third motivation or a benefit from project finance is, it helps to reduce asymmetric information and signaling costs. So typically what happens when a firm decides to issue a particular kind of security, the firm also gives a signal in terms of how good the project is. Let us say, for example, if the firm decides to issue debt, the firm is giving a signal to the market that the project is really good and the firm is confident of repaying back the debt, and that is the reason why the firm is actually issuing debt. So, this is a signal that the company or the firm gives to the market when they decide to issue a particular kind of security. On the other hand, if the firm decides to issue equity, then the market perceives this as a signal of a risk as compared to what it would have been if the firm has decided to issue debt. So, with each and every kind of security that the firm decides to issue, the market perceives certain amount of signal. If the firm says the project is very good, the market is unlikely to believe, because everybody would tend to believe actions more than words. So, if the firm on the other hand decides to issue a particular level of security, then the market takes a lot more signal from that rather than the firm simply saying that the project is very good or the project is very risky and so on. So, normally what happens in a project finance? In a project finance structure, capital is largely raised on a private basis. So, we do not actually raise money from the public capital markets, either in terms of equity or either in terms of debt. So, whenever a firm decides to raise capital from the public markets, then there is substantial investment that is needed to reduce or to provide adequate level of information to the prospective investors. Now, trying to provide as much information as possible without affecting the competitive advantage of the firm is going to be very difficult. If the firm tries to provide a lot of information, then the competitors can take advantage of that information, and that can actually affect the value or the business prospects of the firm that is implementing the project. But in the case of a project finance, since the investment is raised from a closed group, either from banks or either from a closed group of sponsors, the level of information that needs to be shared to a very large group is completely absent. So, the information needs to be shared only to a small set of investors, and these investors are probably a lot more sophisticated in terms of understanding the information that comes from the firm. So, therefore, for the firm that is implementing the project, the effort, the cost and the time that it would need to provide information on the project will be a lot lesser in the case of a project finance as compared to raising money from the public capital markets. So, this is a fairly an important advantage as far as a project finance implementing structure is concerned. And then the fourth aspect that is to be considered is it helps to preserve the financial flexibility of the parent firm. Now, let us assume that the parent firm tries to implement a project, and if the project involves substantial amount of borrowing, then the leverage level of the parent company also increases. So, when the leverage level increases, it limits the amount of borrowing that it can actually do for the future projects. But if the project is implemented as a separate project finance structure, and if the project finance structure, if the borrowing is under the project finance structure, then it does not affect the debt carrying capacity of the parent company. So, the parent company will retain its existing financial flexibility and it can use it for some exigencies in the future rather than completely exhausting its debt carrying capacity. For example, any firm can actually only take certain level of debt without affecting its risk level. Beyond a certain level, the amount of debt affects the risk of the firm, and therefore any excess debt can actually have an adverse impact on the firm value. But by trying to borrow in a project finance structure, the firm is not exhausting its entire debt carrying capacity, and whatever capacity that it exists to borrow further is still retained, and thereby the financial flexibility is fully preserved. So, we have actually seen some of these benefits to the investors, but we should also try and understand how using a project finance structure can also benefit other stakeholders that are associated with the project. Let us say, for example, how can it actually benefit a consumer? Does using project finance structure benefit a consumer? Because ultimately it is very important that unless until the benefits are in some way provided to the customer, the use of project finance is not likely to be sustainable. Let us look at some of the benefits that other stakeholders can expect to get because of the use of project finance. So, the first benefit could be lower product or service cost. Now, the hypothesis is that if you are using project finance, it helps us to provide a service or deliver a product to the end user at a lower cost as compared to the traditional way of structuring. Now, you can come back and then ask me a question, how is this possible? So, there are several ways in which you can explain, but I am going to tell you a very simple reason. The simple reason is, we have earlier seen that in a project finance entity, a major feature is a high level of debt. We are able to support the project, we are able to support the investment with a high level of debt. Now, what does it mean to have a high level of debt as compared to having a high level of equity? We have also seen that when you have debt, the cost of debt is generally lower than the cost of equity. So, when you actually have a high level of debt, then the amount of earnings that is needed to service the debt or to service the investor is going to be lesser as compared to a scenario when you have a high level of equity, because equity holders would expect a higher returns as compared to debt holders, and with a high level of equity means that the firm will have to generate higher level of earnings to meet the return expectations of the investors. Now, how will a firm get a high amount of earnings? By probably charging more. If the earnings requirement is not very high, then the firm can charge or operate at a price point that is at a lower level. So, therefore, the customers are likely to benefit because of a high level of debt, and use of project finance structure helps to actually achieve a capital structure that has a lot of debt. Let us look at another benefit. How would it benefit, let us say, the government? how would use of project finance structure benefit the government? Government today needs to make a lot of investment in various areas of socio-economic development. So there are some areas where it is going to be very difficult to actually get private sector investment. This could be in social infrastructure areas like health, education, rural transport, sanitation, water supply and so on. So these are all some of the areas where it is going to be very difficult to actually get private sector investment, because of the fact that the cash flows from these projects may not be able to give an adequate return on the investment made by the private sector. On the other hand, there are some sectors, for example power, telecom, ports and so on, where it is possible for the private sector to earn economical return on their investments. So given the fact that there are certain level of limitations in terms of how much resources the government has for infrastructure development, governments normally tend to focus providing investment in those areas that are unable to attract private sector investment. So therefore, when you have project finance structures that facilitate private sector investment, a benefit that comes together is public sector is able to focus its investment in those areas where it is most needed, where it is difficult to actually get private sector investment. The third benefit, this again not a benefit that can be specifically attributed to project finance structure, but this is a benefit that can be specifically attributed to having more involvement from the private sector. So the logic is, when there is a private sector involvement in the infrastructure sector, much of the private sector investment happens by way of a project finance structure. Therefore, in many instances private investment infrastructure is synonymously seen as a project finance investment. So when you actually have more involvement from the private sector, the risk is transferred from the public sector to the private sector. There could be several types of risk. The risk could be revenue risk, the risk could be project completion risk, the risk could be financing risk. If the project would have been implemented by the public sector, then all these risks are borne by the public sector. Now if the project is being implemented by the private investor, then all the risks that were originally borne by the public sector now is transferred to the private sector. Now does it actually benefit? Does the risk transfer benefit? Yes, because there is enough evidence, a lot of studies which indicate that private sector is able to manage certain amount of risk a lot more efficiently as compared to the public sector. For example, private sector has a lot more capabilities in terms of managing complex projects. So they may be able to manage the risk of project completion a lot better. Project, when they need very sophisticated management or financing schemes, a private sector is able to provide a lot more innovation as compared to what the public sector would have been able to do so, because there are various limitations under which the public sector firms work. So therefore, when there is a transfer of risk from the public sector to the private sector, it actually benefits everybody, because of the fact that the private sector is in a lot better position, they are much better equipped to manage some of these risks. And then finally, whenever you have substantial amount of debt in the project, the lenders are going to do substantial monitoring, the lenders are going to do a lot of due diligence before they finally agree to fund the project. Now it is felt that the due diligence that would be done by the lenders itself will be a big contribution, because it helps them to identify the weak points in the project, and it helps them to develop various ways and means to strengthen the weak links of the project. So this monitoring by the lenders can itself be a big value addition for the project, simply because of the fact that the lenders will actually exercise the maximum diligence, because if the project is unable to repay the principal or the interest as agreed, then the lenders are going to be the most affected. Third party due diligence by lenders in essence helps to identify the weak points, and by this process of identifying the weak points, one is able to strengthen many areas of the project that might have otherwise not have been possible. Now at this stage we should also try and understand what could be some of the disadvantages of using project finance. We have seen there are various benefits, but then we should also understand there are some limitations, there are some disadvantages of using project finance. I am going to try highlight some of the major disadvantages of using project finance. Point number 1, project finance is a very complex structure. As compared to a traditional corporate form of financing, project financing is very complex. So whenever you have complexity, it involves a lot of senior management time. So the heads of the organization will have to devote personally their time and their energy to successfully complete a project finance transaction. Given the fact that their time is lot more valuable as compared to management at the middle level or the junior level, a project finance structure can involve a lot of investment on the part of the sponsors. Point number 2, whenever there are any changes to any of the contracts, then the contracts will have to be negotiated by all the parties that are involved. For example, if there is a change in, let us say, the concession agreement, then that can lead to a cascading renegotiation between the lenders as well, because when the lenders agree to finance a project, they would have actually based their financing decision based on some terms of the concession agreement. Now if there is a change in the concession agreement terms, then obviously the lenders come into the picture of renegotiation. So likewise, in any contract, in any major contract relating to the project, if there is any change, if there is any renegotiation, then all the parties will have to be involved during this process. The second point is, in a project finance structure, as we have seen earlier, it is also called as non-recourse financing or limited recourse financing. That is, the lenders do not get any guarantee, the lenders do not get the comfort of cash flows from other businesses of the corporation for getting their debt to be repaid. So, there is no direct support, from the parent company or from the sponsors to repay debt. So, there is in some sense what is called as an indirect credit support. An indirect credit support could be by way of a guarantee, could be by way of a letter of comfort, and so on and so forth. So, whenever the sponsoring firms or the parent companies do not provide any direct credit support. So, direct credit support means if the project is unable to pay, then as a sponsoring firm we will ensure that the lenders are repaid. So, that is a direct credit support. So, in a project finance structure we do not really have this kind of direct credit support for most of the projects. So, therefore, the absence of direct credit support could, so the key word is here could, it is not always, it could result in a high cost of debt. So, the interest rate on a debt in a project finance structure could be higher as compared to the interest rates in a corporate financing structure, simply because in a corporate financing structure even if one project fails, the cash flows from other projects will be able to meet the obligations of the lenders. The next point that is normally associated in a project finance structure is a very high transaction cost. The very high transaction costs partly also come from the complexity that is associated in a project financing structure. So, because of the complexity there is substantial investment that is needed in terms of legal, in terms of various ways of corporate forms and so on. So, the legal investment, the legal costs of a project finance entity will be lot higher as compared to the traditional corporate finance structure. And because of the extensive reliance on contractual arrangements in the project finance structure, it leads to a situation where there is extensive documentation. So, there are structures where the contracts and agreements runs to tens of thousands of pages. Now, this kind of extensive documentation, creating and preparing this extensive documentation is not going to be easy. There will be substantial costs involved, legal costs, documentation costs, incorporation costs and so on and so forth. Okay, so, this is another disadvantage of a project finance. We should also have clarity in terms of what is not project finance. Point number 1, we should be in a position to clearly distinguish between a single purpose company formed to realize a given project vis-a-vis a company whose cash flow is generated by a single project. So, when you have a single purpose company, that is a project finance entity, but if you have a company whose cash flow is generated by a single project, that need not necessarily be a project finance company, because today the company's cash flows are generated by a single project, tomorrow it could implement another project, and a few years down the line it could undertake a third project and so on. So, the company does not have any restriction in terms of the number or the type of projects that it would implement. So, therefore, it should not be construed as a project finance company. A project finance company is one which has a single purpose of developing a given project. We should also not consider project finance as a way of supporting a project that is economically weak and which cannot be funded by the traditional corporate finance structure. So, project finance is a structure that helps to overcome, that helps to manage certain level of risk a lot more effectively, but at the same time it should not be seen as a way of financing projects that are riskier. It should not be seen as a way of financing projects that is economically weak, or as a way of financing projects which can provide suboptimal returns to the investors. All of this is not the case of project financing. Now let us quickly look at a summary. So if we really look at it, there is a simultaneous relationship between infrastructure capacity and economic growth. When the economy grows, it creates demand for more infrastructure capacity, and when infrastructure capacity is created, it results in higher economic growth. So there is, in some sense, a dual causality between economic growth and infrastructure capacity. So many developing countries today have pursued what is called as a path of liberalization to promote economic growth. So there were constraints in terms of how much growth can be achieved in the traditional public sector dominated model. So there has been more and more sectors opening up for private sector investment, so that is called as a liberalization. Liberalization is opening up various sectors that were restricted initially for public sector investments to also for private sector investment. So opening up the economy, which is liberalization, leads to privatization. And when we talk about privatization, there are many instances where we do not really have only private participants, but we have what is called as a partnership between the public and the private. So we have what is called as a public private partnership, and this public private partnership leads to use of project finance structure. So the traditional public sector dominated, we do not really have this kinds of project finance structure. The project finance structure emerges only when we have private sector investments. So a consequence of having a project finance structure is you have a high level of debt, and when you have a high level of debt, what happens? It results in a benefit, the benefit being low offtake cost to the user. And when costs are lowered, then there are more people who are willing to consume the products or the services. So low offtake costs, it increases offtake, it facilitates community involvement, more and more people are willing to or able to consume a product or a service, and when more and more people are beginning to consume, then it results in better capacity utilization of the project. So when higher capacity is being utilized, then it creates a demand for more infrastructure capacity, and then the cycle continues. So what we actually see is a very dynamic relationship between economic growth and infrastructure capacity on one hand, use of project finance structure on the other hand, and 3, benefits to the consumers that results in better utilization of infrastructure capacity. So with this schematic, I am going to end this discussion on project finance, but before we do that, a couple of thought questions for you. What could be the broad trends that could be seen in project financing? So, project financing has developed, evolved over the last few decades. What are the project trends? What are the broad trends that we can actually see in project financing? Question number 2, in terms of various loan parameters, do project finance loan differ from other loan categories? There are several types of loan categories. So, between these different types of loan categories, project finance is one type of loan category. So, are there differences between project finance loans vis-a-vis other loans? So, think about these questions and we will discuss in the next session.